Hey guys, Toby Mathis here, and a question I get all the time is how do I build up wealth systematically? So here's the thing. I've been a tax attorney for almost 30 years, and I work with investors, very successful people, tens of thousands of them, with our firm Anderson Business Advisors all over the country, and we watch what they do. Like we do the tax returns, we do 10,000 tax returns a year, so I can see who makes money and who doesn't. And so we've learned a bunch of strategies by watching our successful clients. It's kind of like doing a study. In fact, Dave Ramsey did a very famous study of 10,000 millionaires and came out with characteristics that if you follow them, you will get similar results. And those characteristics, for example, is using a system to build wealth. So today we're going to talk about using 4 buckets to build wealth. And I'm going to show you the different levels of how much you have, like starting at 0 on up to if you're over $1 million, where you should be allocating those monies very systematically. Because what we see all the time is somebody's rolling the dice and they're taking a gambler's mentality and it costs them. If you want to be successful, it's mathematically almost impossible to fail if you follow these types of strategies. And so I'm going to show you how they work. So I have my 4 buckets. I'm going to draw them up for you, and then there's 3 levels in those 4 buckets. And I'll explain this and lay it out. But let's go over the buckets first. We use something here at Anderson called the 30-30-30-10. Now, I'm going to reverse that to be 10-30-30-30-30. You'll see why in just a second. It's because for each bucket, we're allocating a certain percentage of our assets. And when I say assets, I'm not talking about my house. I'm talking about assets that feed you, assets that create income. I have an easy rule to remember whether something's an asset or a liability. Assets feed you, liabilities bleed you. In other words, just look at your bank account. Is this something that's having a positive impact on your bank account? That's an asset. If it's something that's taking money out of your bank account, then it's a liability. And if it's doing nothing, like cash, gold, things like that, then it might be considered a cash or cash equivalent. And that is our first bucket. This is, I'll just call it cash, for lack of a better word. It's cash or cash equivalents. This is kind of like where we put our hedge against inflation. This is where our emergency fund is. This is where our savings are. This might be where things like bonds might be living. This isn't something where I'm taking a lot of risk. This is something that, worst case scenario, like if I put it in US dollars, it's going to lose value over time because of inflation. So we want to hedge against that, but we want it to be very liquid and easy to access. That's bucket number 1. Bucket number 2 is 30%. And this one, I'm just going to write stocks, but I want income producing stocks. I don't want things that are just sitting there and I'm hoping they're going up. I want to make money on my portfolio on day 1. I want it to produce income. And for those of you guys who are used to buying and hoping something appreciates, this is not that. This is buying something that is paying a dividend, buying something that I could sell a cash secured put to get into, use the wheel strategy. This is something where I can write options against so I can produce additional income. And then if I do sell it, then I also have appreciation. So if you're counting, that was 4 different ways I can make money off of one stock. And that is a bucket that we use. Bucket number 3. These look like they're getting smaller, right? I'm making sure I fit on the board. Is real estate or real estate equivalents. And when I say real estate, I want to be subject to real estate. And I'm using 30% of my portfolio there as well. And then that last 30%, this is managed money. And I'm just going to write manage there. Now, there's specific reasons why we use all these. That managed money is where you are allowing somebody else to make some of those decisions. And the way we use this is we might start off with like a mirrored portfolio. Hey, rather than just you pick all your stocks, maybe you're using an ETF, or maybe you're mirroring something like, Warren Buffett's portfolio, or a standard portfolio that has a low risk, or whatever you're willing to take. Maybe a young person, you might have more risk. Maybe you're taking on the Qs or something like that, saying I'm all in on tech or AI or something, but you are not the one making the decisions. In a perfect world, you're going to have somebody helping you make those decisions. You're actually going to have a money manager at some point. But I'm going to show you each level so that we can build this wealth. And I'm just going to draw a couple of lines across here so that you see them. I'm going to go over here and I'm going to write down the levels. Level 1, level 2, level 3. Level 1 is where we're going to start. This is less than 150K. Less than 150K. That's going to be a lot of you guys, right? We're just getting started. You're going to be like, hey, Toby, I don't have a ton of money. You know, why am I can't use the 30, 30, 30%. I'll show you where to start, and I'll show you which bucket to start filling up first and how we move along, but we'll do it in little increments. Bucket number 2 is 150K to $1 million. So this is where, boy, that sucks. This is 150 to 1 million, and then this is 1 million plus. You get over $1 million bucks, then I'll show you what items in each bucket you should be investing in. So let's start right at the base level. Let's start over here, because this is where you literally begin. Your first $50,000, I'm just going to write 50K, is right here, is our cash equivalents and our stocks. This is our first 50K. And you're going to say, all right, how does that work? Am I $25,000 in cash, $25,000 in stocks? No, we're still going to use 10% is where we want our cash or cash equivalents. So when I say cash or cash equivalents, I'm talking about savings accounts, or bonds. That's level 1. If you're under $150,000, you start with savings and bonds. And don't worry, I have a visual. I'll put that up so that you guys don't have to try to read all my writing. We'll put it up. Maybe I'll make it an attachment and just you can download it so you can take a look, so you can follow along. But that first $50,000, if you can do the kind of the math, it means you're going to have $5,000 here, and you're going to have $45,000 in, I want dividend exposure. I want dividend ETFs or kings, aristocrats, things like that. And for those of you guys who do not know, I'm going to put a little thing around these so you can see them. For those of you who don't know what a dividend king is, that's a company that's been increasing its dividend for 50 years or more. Why do we immediately start there? Because we do not want market volatility to hammer us. You have drawdowns of 50% in the S&P. So if you start buying securities, they're very liquid. I could turn them into cash in 3 days, but I don't want a ton of volatility when I'm at level 1. When I'm at level 1, I want things that are very steady Eddie. And that's why I drift towards dividend ETFs, ETFs that are built around dividend producing stocks, which are aristocrats, are 25 years of increased dividends at least. Once you hit 50, then you're a dividend king. So I tend to focus on those two categories in that first bucket. Why? Because like in 2008, when we had that major flux, I think the market went down 38%. Dividend kings went down less than 20%. Like they are a lot less volatile, and that's where we start. And again, I can already hear some of you guys going, but I need to make money. You make money systematically over time. Once you cover the basics, then you can take risk. And you'll see as we go up, you're going to be able to take additional risk. So we go $50,000 here. Then we go $50,000 here. Now, keep in mind that when I say $50,000 in the real estate bucket, I don't mean just straight 50,000. You're still using your 10% in cash. So when I say $50,000, it's $5,000 here, $45,000 here, $45,000 here, an additional $5,000 here, so that we have up to $100,000. 10,000 of it, 10%, will always be in cash or cash equivalents. In real estate, our level 1 activity is going to be REITs. And for those of you guys who do not know what a REIT is, It's real estate holdings that are publicly traded. So it's basically a stock that you buy that is real estate. So there's Federal Realty Trust, for example, that is a dividend king. It's been increasing its payout every year for more than 50 years, and it is real estate holdings. Or you can go or Public Storage, like any of those, you can invest in. You can go look. There's a ton of real estate REITs. There's apartments. There's everything. As long as it's exposed to real estate, that is what we want to see. And that is where you start your next bucket. So we go $50,000, $50,000. So you should be up to $100,000 now. Then you go into the third bucket, the managed money. And I would say that you're going to do ETFs here. Those are exchange traded funds, is a bucket of stocks. So you're buying like the S&P, for example, SPY or VOO. You're just buying the entire, like you're buying a big bucket of stocks. There's all sorts of ETFs you can go look at. Personally, I like Devo. That's Kevin Simpson's fund where he does covered calls and he does dividend stocks. I actually really, really like that. So DIVO, or if you like international, IDIVO, or you do both, or you do a combination. But you start filling that bucket up for $50,000. That brings us to the end of level one, where we're at $150,000. That's why I say less than $150,000. These are the categories over here. We have savings and bonds, dividends, ETFs, dividend kings, like if you're just buying stocks. Then we go to REITs. Hey, we're filling that bucket up. Then we're going to ETFs. Notice there's nothing here that's crazy. You haven't heard Bitcoin out of my mouth. You haven't heard AI stocks. You haven't heard speculation. We're not going out and we're buying SpaceX yet. All that stuff is going to come, but you got to make sure that if in up until that point that you're investing in things that are appropriate. You cannot afford to have a 50% drawdown. You can afford to have a 25% drawdown. Like, we need to see this money compounding over time. And our most conservative layer is that first 150,000. Then we go to level two. In level two, we're going to start filling up these buckets, kind of all simultaneous. But we're just looking, and on a quarterly basis maybe, you're looking at it saying, how do my percentages look? Because again, stocks go up, stocks go down, so you're going to look at it and say, am I fairly allocated? Is my cash or cash equivalents roughly 10% of my holdings? Is my stocks, maybe they went up a whole bunch, are they roughly 30% of my holdings? My real estate, maybe your REIT just exploded and go way up, is it roughly 30%? Because it might be something where you're like, hey, I don't have to put as much in there right now because it's going so well, and I'm allocating into these other buckets to kind of keep parity. That's okay. That's our idea, but what should we be investing in? Level two assets of cash or cash equivalents might be things like gold, might be things, precious metals. So I put here on the chart, gold and silver. This is where you start hedging against inflation. Some of you guys love gold. Gold goes up, gold goes down, silver goes up, silver goes down. Talk to some folks in Anchorage, Alaska, right? They lost buildings over this thing. You try to corner a market, sometimes it fluctuates. So there's still risk, and it's not as easy to turn into cash as just having things in like a bond. By the way, when I say bonds, they're actually ETFs that are bond ETFs. So you could do that, or you could just do a money market, you could do savings. Then we go into, hey, I'm actually buying something. I'm buying physical gold. I might be placing it at a safe, or I might have it held by a custodian. Then we go to the next category, our stocks. That is going to be your covered calls. This is where I'd want you to start. This is where you're doing, if you don't know what a covered call is, I'm going to put, or just type Infinity into the comments, and I will send you my book, a PDF version of my book called Infinity Investing, where it teaches these strategies. And we teach classes on this, usually twice a month. You'll be like, you can go and see, we do a real estate class, a stock class. you can learn this strategy in the stock class, covered calls and wheel strategy, where you are learning how to sell someone the right to buy your stock or the right to sell you a company. And they literally pay you for that. So if I own a stock for $100, I could sell somebody the right to buy it from me at 105. And you're saying, but that's more than what it's worth. Exactly. But they're paying me, and then if it goes up and goes above 105, they may call you out and take your stock, but you made money. And you made money on the call. That's called a covered call. That is a stock market landlord. You are getting paid to rent out your stocks in a way. And we like that. We like that a lot. I'm a real estate guy. I like it when I have money coming in every month. In covered calls, it could be every week. The wheel strategy is when you actually get paid to buy the stock too. Somebody pays you to make you buy a stock at a price that is less than it is right now. Sounds weird. Same $100 stock, you might sell someone the right to make you buy that stock at 95, and they might give you $1 for it. I'm not kidding. That's what you can do. That's why, again, type in Infinity. I'll send you a PDF of the book. I'll also put it in the show notes so you can see a link. But you can absolutely read the book, learn the principles. Infinity Investing was an Amazon bestseller, got a gold medal at the Global Book Awards. It's not, like, this is a good book that you read. It's not, like a little 10-pager. This is, close to 300-page book that lays out how this all works and the philosophy behind building a cash machine that pays you constantly. So everything that I've pointed to, I want you to have income coming in. It's not enough just to own something. I want it to pay you. That's an asset. On to our real estate. What type of real estate should we have over here? This is where we get into our single family rentals. I want you to start, if you're a level 2, you're over $150,000 on your real estate. You could always stay at REITs. Hey, this is what makes me comfortable. But I would say, hey, start looking at adding in single family rentals into your portfolio. Buy a couple rentals. Realistically, I think most people could retire off of 7 rentals. If you buy good rental properties, you can get there. And it's substantially less than what a financial planner might be looking at, saying, you need to have $2.5 million. Well, if I can get to 7 rentals, and some of you guys are going, wait a second, rental properties are really expensive in my neighborhood. You can still buy them in Charlotte, in Indianapolis, in Winston-Salem. There's a ton of different, Idaho Falls. You can do manufactured homes in King, North Carolina. Like, you could do these things and you could buy them relatively inexpensive. Kansas City, Missouri, absolutely killing it. Low property taxes, inexpensive properties that create little cash flow machines, $150,000. So you start looking at those. And by the way, you can be introduced to those through one of our affiliates in Infinity. So we will show you where you can find properties like that cash flow with property management in place, so you can buy little cash flow machines. But I would be looking at doing single family rentals as level 2. Again, you're between $150,000 and $1 million. That's appropriate. Under $150,000, don't go buy a single family residence. Some of you guys are gonna be tempted. Hey, I'm gonna take I have $30,000 saved up. I'm going to put $25,000 down on a property. I'm going to finance $200,000 of it. And then the roof has a problem, or you have a tenant that destroys the place, or you have a liability occurrence, or it just has something you didn't know about and you need to fix a bunch of stuff and you don't have any money to do it. That's how you get in deep, deep doo-doo. So I don't want you doing that until you have at least $150,000 buffer, so that you have the ability to be liquid and cover those types of situations, because they do happen. Statistically, you're going to end up going like this, but it's not a straight line. Sometimes there's bumps on the roads, and the less property you have, if you only have one and it's vacant and it needs a new roof, then you just got, you're in a bad spot if you don't have enough money to handle that. You get up to 7 properties and they all level themselves out. So you're going to start there to where you can handle any bumps in the roads. And then you're going to go managed accounts. There's a reason I put that at $150,000 to $1 million, because most money managers will not manage your money unless it's over a certain threshold. So they're going to look at you and go, all right, what's your accounts? And they cannot take you on unless your account is over a certain value. I like that managed money. I would like you to have a relationship with somebody. I have 3 financial advisors that I work with. I think they're fantastic because I like to compare them against each other. You use them so that they're giving you great ideas, but I have a great one at Raymond James. I have a great one at Morgan Stanley. I have a great one at Schwab. And I love to just bounce different ideas off of them. And then you'll see in that same bucket, there's other opportunities for different types of investments once you get over and become an accredited investor, once you're over the $1 million threshold. And keep in mind, this is without regard to your house. I don't want you throwing your house in there. You can put like a 401k or something in there. And of course, 401ks, you're going to be kind of stuck in this bucket, which is fine. It means maybe you're going to be moving more of your stuff that you're doing into these buckets. So if I have an employer 401k that's sitting there with $200,000 and I have other investments of my own, I'm not going back to this bucket necessarily. I'm going to start trying to spread it around and put it in other buckets. All right, level 3. You get over $1 million, now we can take on risk, an insane risk. And what's the epitome of crazy risk? Bitcoin and all that cryptos. Bitcoin goes up, then it goes down, then it goes up, then it goes down. Yeah, you can't be doing that if that's what you're living off of, right? So this is appropriate. Once you get to over $1 million, start looking at allocating into those higher risk assets. The next level, if we're in bucket number, in the stock bucket where we have 30%, we are talking about speculation. This is where you're putting your money into the AI stocks. This is where it's boom or bust, right? But you could handle that volatility when you're over a certain point where you don't have to sell things to live. Down here, and you have a fluctuation and you have to make some bills and you're having to sell things when they're down 40% or they're down 20%, that would really be horrible. Here, I can wait. I have enough of a buffer that, hey, as the market kind of works itself out, there's a lot of volatility. I can take that risk and I can have more speculation. Because frankly, if I lose that, it's not going to destroy me. I lose this and it's my first $50,000 that I'm making. That's very, very destructive. That could keep you from ever investing again. That could keep you pinned down. So we want less risk at level 1. Now we're willing to take on a lot more risk on level 3 because we're already over $1 million. We're not going to be starving anytime. For real estate, this is where you go into multifamily and commercial. And again, I know some of you guys are being taught to go right into multifamily. Hey, just go straight into apartments. Don't do that. Don't do that unless you're an accredited investor. I'm just going to say that. Don't do that unless you either really know what you're doing and you can handle that risk, or like you have specialized knowledge, or make sure that you have buffer, that it's not like you can wait 4 or 5 years. I've been there, done that. I have a ton of real estate. I've had properties that I bought. It took 10 years to recover. They sit there and they pay you. That's great, but I don't want to be in a situation where I cannot handle this, whether maybe there's an adjustment if you're using leverage. I'm not a leverage guy. If you get to know me, you'll know that I'm not a fan of using of other people's money. There's all these folks out there like, I have $1 billion of leverage. Yeah, that's what destroys people. Maybe you're going to make money on it, but that's risky. You're playing with fire. And maybe you are so good that you can do that. There are folks out there that are absolutely amazing using leverage, but my experience, the most successful people don't play a lot with leverage. But I can handle it if I'm over that $1 million threshold, and if it's kind of more my risk money. I can handle it if I get into a situation where, oh shoot, I bought a commercial building and I just had some bad news. You had a flood, or the AC units went out and they're $100,000 to replace AC units on a building or something like that. I just lived through that one too. You have to be able to handle that little bit of a hit, and it takes years to recover it. You do, and then you do really great, but you don't want to be in a situation where you're forced to sell. You're seeing that all over the place right now with all these syndications where people thought interest rates were going down and they're getting bled, and they only have a certain amount of time that they can handle being bled before they're like, I'm giving it up. So that brings us to this third area, syndications. And I'm going to call syndications by a very broad paintbrush. This is where there's things like oil and gas. This is where you're doing into multifamily syndications. This might be early startup companies. This might be pre-IPOs, because this is speculation. This, you may be sitting on it for 5 to 10 years before it matures and then pays you off. And sometimes it's huge. Sometimes you have complete losses in these things. Syndications are inherently risky. When you hit, it tends to be a triple or a home run. And when you don't, it tends to be a strikeout or maybe a single or a couple of doubles. But it's very, very risky. So there's high reward, but also there's a lot of exposure when you're doing syndications. That's why they're not available typically to everybody. For most part, a syndication is only for accredited investors, which means you're making over $1 million, or you have a net worth of over $1 million, or you're making a lot of money every year. Like, you can't even invest in most syndications unless you meet the qualifications as an accredited investor. So now I've laid this out for you. We're starting off here, level 1. First $50,000 is in these first 2 buckets. 10% is going into cash or all the time, cash or cash equivalents all the time. We're always making sure that that's we have dry powder. We have the ability to withstand an emergency. Some folks immediately start off with a 3 to 6 month emergency fund. I'm not saying be that crazy, because frankly, stocks can be turned into cash very quickly if you go into these. What I am saying is that in the very beginning, it's always going to be 90-10, 90-10, 90-10. You're going to go 50,000 in stocks and 10%, with 10% of that being cash or cash equivalents. Next $50,000, again, it's real estate, and part of it's going to be over in that cash or cash equivalents. $50,000 into ETFs, part of it's going to be in cash or cash equivalents. So if I have $150,000, that means I have 10% would be $15,000 in bucket 1, and I would have 45, 45, 45 in each of these buckets. Does that make sense? So I've done $50,000 increments. I start with the cash or cash equivalents plus my income producing stocks. Then I move to REITs. Then I move to ETFs or mirrored portfolios. And once I hit $150,000, now I'm just using these 10-10 or 10-30, 30-30, 30 as my litmus test every quarter. Some of you guys might do it every year. Some of you guys might do it half year. Whatever suits you. Just periodically you're saying, hey, I just want to be looking and saying, am I sitting at 50% over here, 0, something here and something here, 25, 25, right? You want to make sure that we're spreading this out. There's an old adage that, that money is like dung. If you leave it in a pile, it stinks, but if you spread it around, things tend to grow, right? So we're trying to spread it around. We're trying to allocate it in different categories in an intelligent way, systematically. This is what I see works for people consistently. Now, are there guarantees in life? No, but we're minimizing our risk, maximizing the chances that we're going to be successful. And from what I have seen with my clients, again, almost 30 years being a tax attorney, we do tens of thousands of tax returns. I work solely with investors, people that are real estate investors, stock market investors. So I see who makes money consistently, who doesn't. And I can just tell you anecdotally that they use systems. If you wanted a system for how you allocate money, I've done plenty of videos on that. I use the 70-30 rule. You live off of 70%. The other 30% in thirds goes giving, paying off debt, and investing. So you're always making sure that you're following a very simple system and that you know where things are going, because money is pressure. It wants to find a home. And you want to be able to say, oh, when that money comes in, it's going into, hey, my savings account, high yield savings, maybe a bond ETF, maybe it's a money market, but I'm placing it right in there. And I'm moving a bunch of money over here. Hey, if for every $10 I get, $9 goes into my dividend kings. Maybe it's going into an ETF. Maybe, and that one I'd be fine if you also use something like a Devo or the Schwab dividend fund. All those things I might be putting there, and it's saying, hey, you know what, I feel really good about putting that money. For every $9 goes there, I put $1 into my ETF, and I'm just filling that bucket up until I'm at 50,000, and then I go to REITs, and I'm looking for different REITs, and I fill that up, and for every $100 that comes in, 90 is going into the REIT, and $10 is going into my cash or cash equivalents. Then I get over here, and I'm doing ETFs. I'm just saying like, hey, maybe I want to do a technology ETF. Maybe I want to do some of these things, but I'm following a managed, somebody else putting it together. These buckets of ETFs can be hundreds of companies, which is fantastic. It means I'm getting it, like you do the whole market for all I care. Statistically, it goes up. I think it's over 10% right now in the last 7 or 8 years, it's much higher than that. And you're looking at it going, man, I am doing well if I am allocating those resources. Where you blow yourself up is if you are down here with your first 50,000 bucks and you immediately go into Bitcoin and you watch it drop 50%, or you immediately go into a speculative stock that goes to zero, or you immediately go into multifamily and you can't handle the cash drag that occurs in that first year, or you immediately go into a syndication and there's risk and you happen to be in a syndication that goes belly up. You don't want that to be you down here. You want that to be up here where you can handle that risk and the rewards are going to outweigh those negatives. You don't want to be put in a short-term spot where it can really harm you. All right, guys, I gave you a lot. And I want to say, if I was you and I was looking at this information, I would want to learn a little bit of background about how I can implement this type of system. And so I'm going to give you, again, a free e-version of the Infinity Investing book. Just type in Infinity down in the comments and we'll send you a link. If you put in free book, I'll send you a link. And attend an Infinity class where you're going to learn about cash flowing assets, things that pay you to own them. And Infinity, if you're wondering where that name comes from, means I can live an infinite number of days without having to work. I don't need to trade my time for money. I have assets that cover all my expenses. And that's what we're trying to get to, is because once we have that, then we have our needs met, and now we can be more aggressive in our investing. Good luck.